US dollar finishing the week lower, continuing its multi-month downtrend, coming ahead of those non-farm payroll numbers Friday. Question being, will a robust jobs number be enough to spark a sustained greenback recovery, minus support from the Fed? Well, let's take the view from Chris Gore from Go Markets in Melbourne and Jim Vrondas from Oz Forex in Sydney. Gentlemen, good morning to you. Let's, of course, Chris, just ponder that one, sort of on a bit of a knife edge, given that important number Friday. How do you read it?
Well, at this point, if we do see a robust figure come out of the States in terms of non-farm payrolls, it most likely will be supportive. We have noted that in past non-farm payrolls releases, the US dollar is very much contingent on these numbers, and it really is the missing link in the recovery if we should see a robust figure come here from the States. So at the moment, market's expecting around about 183 to 190,000 new jobs in the month of January. So importantly, it's one figure that certainly could upset the balance of risk. And we are expecting, however, that we may very well see a reprieve from this jobless situation. And of course, in the previous month, or last month especially, if we cast our minds back, we had less convincing overall result, but the jobless figure fell. Importantly, that was attributed to extreme weather conditions in Central America. Those conditions have since dissipated, so one would expect we may very well see this translate to a bit of a rebound in the job situation. As you mentioned in the intro there, it's very important as well to get a sustained greenback reversal that we have the support of the Fed. So if we should see a figure come in better than expectations, above the neutral levels, it would be also positive to see some good feedback come from the Federal Reserve, and that should mark the US dollar's reversal, albeit for the short term.
All right, Jim Vrondas, what response will the Fed give, though, to that downward revision to Q4 GDP? It's a hard one to sit on the sidelines over for too much longer.
It is, and the Fed has been quite vocal in saying that it will take some time, quite a long time, for the jobs market to improve. That GDP number will probably reinforce their view that they're not out of the woods just yet, and they'll have to continue along the lines with the stimulus that they have been putting into the market. So I think we're likely to see the Fed kind of reinforce that message that there's a long way to go in the recovery at this stage, and that GDP number that we saw on Friday probably obviously makes that message a lot clearer and a lot easier for them.
And put it into context, Jim, as well, you've got the $8 impressive rise. It's nearing some important peaks against the greenback now.
Yes, definitely. It's been quite resilient. If you look at the risk aversion that hit the markets with what's going on in Libya and in recent times, that the Aussie dollar is still around these levels, and if pressing against that 102 mark, which is quite a critical technical level. So yes, quite a strong performance by the Aussie dollar, as we've seen. Still a buy on the dips below that parity level, and the market's still quite confident to be holding Aussie. Getting it through that 102 to 102.5 area will be a lot of hard work, but if it does get through that, then I think we're seeing a new base around parity for now.
Chris Gore, I put it to you that hard work could be made a whole lot easier if we do see, ironically, do you believe, a continuation of Mideast tensions and the resilience of crude as one barometer, with our dollar so much linked to global commodities in the round? Is that sufficient to link it to and say we'll get a bounce along with that continued rise?
In some ways, yes. What we have to also take into consideration is global growth at the risk of this imported inflation through higher crude prices. So if we see this translate to negative conjecture in terms of how these high commodity prices will affect the global growth situation, US growth, of course, and that of Europe, we may very well see this translate negatively to the Australian dollar in the week ahead. But at the moment, all things being equal, the oil price is quite buoyant, and we can attribute some of these commodity linked currencies to some of that buoyancy in commodity markets, and to trace that back to US dollar weakness, which of course gets a leg down when we do see this strength out of the commodities such as oil, and that's been predominantly one of the reasons for the Aussie buoyancies. As Jim was saying, I couldn't put it better myself, that the Aussie dollar has been largely resilient. My opinion is that it's largely attributed to US dollar strength in terms of local economic feedback. We haven't necessarily seen that translate to the the better side of neutral. It's quite been, I suppose, very much a neutral ground and locally, but certainly that US dollar strength there will continue to, well, US dollar weakness will continue to no doubt support the Aussie if we continue to see that.
Jim Vrondas, though, working against it and closer to home, what the fortunes of the New Zealand dollar, because it did seem that we were dragged lower last week on that RBNZ rate cut speculation. Doesn't help matters that we're now sort of seeing the worst realised economically for New Zealand's second largest city.
Yes, definitely. The ramifications of the natural disaster that we saw are still being felt and will continue to be felt for quite a long time. Obviously, the RBNZ is considering reducing rates to help stimulate growth and that recovery. But if that does happen, we're of the view that it might be 25 basis points and still a risk that it may not happen. So the Kiwis can find a little bit of a base around that 74, 74.5 at the moment against the US dollar. As we said last week on this show, that Aussie Kiwi still looks quite strong, and we're still targeting a rate of around 136.5 on that cross rate. It's still looking quite like a good trade at the moment.
Jim, how do you understand the pass-through then, given that pretty much all New Zealand banks are owned by Australian banks, barring their own state bank there, and the phenomenon of higher funding costs? If there's an official rate cut and yet the banks are still encumbered by that offshore phenomenon, will Australian banks sort of have to sort of absorb that, and could it be Australian customers that pay the price for what's going on in New Zealand?
Could do. Obviously, those funding costs are being absorbed and will be absorbed by those parent companies, if you like, out of Australia and those Australian banks. So, to some degree, yes. Whether that means that it will translate to higher interest rates here in Australia for local customers is still a little bit early to tell. The major funding, obviously, the Australian banks have comes from offshore, and a lot of those exposures are domestic. So, whether that New Zealand makes up such a big part of their balance sheet depends on the bank, I guess, and their focus, particularly in the New Zealand market. So it's a bit early to tell. We'll see when the banks actually start to deliver some more reporting on this type of numbers as to what impact it really will have.
All right, Chris Gore, if we go global now as well, and we look at the situation in Europe, the dilemma on whether to kind of cool the largest economy there, Germany, or allow that to power on at everyone's expense. ECB's view on rates. Money markets are saying they'll sit on their hands.
Well, money markets are suggesting that over the next 12 months we'll see around about 1% of interest rate hikes for the European Central Bank. And to translate this back to euro activity, there's been a lot of speculative cash thrown into this, the premise of interest rates. And to my mind, that puts the euro at a particular risk of reversal. Importantly, we still have some formidable headwinds for the European economy. The cost of business remains high. Portugal's bond markets are still above that 7% benchmark, so around 7.5% yield on Friday there. So some still headwinds to be faced there. So we tend to think that the market's pricing in just a little bit too much there, and we may very well see euro price activity either relax as interest rate expectations unwind. Alternatively, we see some support once again for the US dollar, as we were talking about before.
All right, Jim Vrondas, what about CPI data? How key is that in the determination of Jean-Claude Trichet and rates?
Well, definitely inflation's been at the forefront of their communication to the markets and their thinking on interest rates. So it is very important in terms of the scope of their mandate, obviously, to control inflation. So we will get some more inflation numbers out tonight out of broader Eurozone. We saw German CPI out on Friday, but today we'll see the broader Eurozone CPI or inflation data come out. The market is expecting that to be a little bit on the strong side, hence the pricing in of those interest rate hikes. So it could be in for some disappointment here. We could see Euro-US pull back towards that 136 or 135, we think, in coming weeks.
All right, and a view as well on the yen, taking that from you, Chris Gore, you know, its trajectory, the likely response on markets to that, what might drive it sort of lower, importantly, this week?
Well, yen very much at the mercy of risk trends, of course, and we should see a reprieve from what's happening in the Middle East, or at the very least a stabilisation of these Northern African issues. We could very well see some funds move away from this safe haven channel and back into things like the US dollar. Another important factor there, of course, is a whole range of economic data that's coming up from the States. We have data in terms of manufacturing, ADP employment claims, and of course non-farm payrolls, and the Fed's beige book as well. So no doubt they in some ways will decide where the balance of risk falls. The Japanese economy is still fundamentally in an unsound position. So in terms of the yen's strength, it may not be a continuing theme for forever. I mean, the Japanese economy is still some 205% debt to GDP ratio, and sooner or later that'll manifest into yen price activity. And so we can expect, as the world rebounds, we may see that yen have a bit of a reprieve and fall against those currencies once again.
They've got their own data this week to eye industrial production, retail sales and housing starts. Gentlemen, thank you. Have a good week.
Thank you.
Thank you.